Okay, let's begin. Good morning, Checkmate crew. Today is November 16th, 2022. It is Wednesday, 30 minutes after the opening bell of the New York Stock Exchange is 10 a.m. Eastern Time. Yours truly, Mickey Blindside here with your market memo. Okay, so today we're starting off a little bit lower. We're seeing a little bit of a retracement in the markets. We had a huge rally for the last, let's call it a few days. Yesterday there was some news came out that there was a rocket that went to Poland, a Russian-made rocket that detonated or landed in Poland, and the initial reporting is that that it could have been Ukrainian fired. All right, that the Ukrainians were targeting a missile that was coming at them, and it could have accidentally landed in Poland instead of hitting that Russian missile that they were trying to block. So that is the initial reporting. At least that's what I saw. I don't know if anything has changed. I haven't checked in the last couple of hours, but that's at least what I saw a few hours ago and last night. And so let's see how that develops. We do have our FEZ puts, which are not doing, I mean, they're not necessarily doing that well right now, just because Euro Stoxx really didn't really sell off. I mean, it did sell off a little bit, but then it bounced right back. So I don't think the markets are taking this that seriously. So, what's most important is the market's reaction. And it seems like it is a muted reaction. Although, if you look at the actual Euro Stoxx index priced in euros. So right now, FEZ, is priced in dollars. So whenever the dollar goes down, like it is right now, FEZ may just go, even though FEZ is flat. Okay, so or not FEZ, but even if the Euro Stoxx index is flat in the euro currency, if the dollar goes down, you need more dollars to buy Euro Stoxx index, and so therefore FEZ could go up just because in terms of dollars you need more dollars in order to get into the Euro Stoxx index if the dollar goes down. So if we just look at the actual Euro Stoxx index, it is down. The futures are down. The actual cash index is flat. So that's why we're seeing a little bit of a pop in FEZ right now. I mean, we'll see. I mean, I do think that this is our supply zone. I think there's a lot of supply right here. I do think that though, if we do sell off, it may not be as steep. At least if it happens before January, I don't think it's going to be a very steep drop. If it gets to around 3,600, 3,550 to 3,600 zone, I might just take profits. It won't be that much. It'll probably be like 20 to 50% of our spread. That will probably be our profit rate if it gets to those levels. I do think that there's gonna, the people will buy that dip initially on that 3,600, 35, 3,600 just from our liquidity data. Liquidity is improving, and we'll go over that in just a second here. But I just wanted to share that with you guys. There was a lot of, if you get your news from Twitter or social media, you would think that this is like some end of days scenario. I don't think that's the case. Again, the market's not really showing that. I do think though that we could get a pullback just because this is kind of a supply zone right here. All the people that kind of that bought here and here. There was a lot of volume there, and I just think that's probably where there's a lot of bag holders right here too. A lot of people bought the dip as this went up right here in March, April. A lot of people bought this dip only to be holding the bag, and so I still think that there's still some supply here. Although if it does dip, I don't see it going down too much just because of our liquidity data that's improving. Now, of course, after, if our liquidity data deteriorates, like our junk bonds ADL starts going down, the New York Stock Exchange high low, there's more lows being made than highs, advanced decline of the New York Stock Exchange going down. If we start seeing all of this and the dollar's going up and the euro's going down and the British pound is going down, if we see all of that, then maybe if it does sell off, then maybe it goes down a little bit more. But until I see that, until I see all of our liquidity data again change towards weakening again, I will be taking profits relatively quickly. And then, on the next pop, maybe we reload. We'll take it one day at a time and we'll see what happens. Okay, so I just wanted to give you guys an update because we did see those headlines yesterday. A lot of people were asking questions and a little bit worried about their positions based on that. Again, I just don't see that as a big issue, but we'll see. Okay. So that's the Euro Stoxx index. We talked about liquidity just for a second here. Let's take a look at that. Liquidity data is improving. Okay, we're seeing advances over declines in our junk bonds advanced decline line, and as long as that happens, and yesterday I went over why we look at this. So if you guys want to see a more in-depth description of what we look for, why we look at it, and why this is important, go look at yesterday's market memo. I go over why we look at this, but yesterday, at the end of the day, we saw that the advances were a lot higher, and so it is still an uptrending line here. And again, I think that this rally may have some legs. We are seeing that the market is down. I mean, it doesn't mean just because the day before there were more advances than declines doesn't mean that the market has to go up the next day. One day does not make a trend. It's about the trend. Can the trend keep intact? Can that short-term rally, can it sustain itself? That's what this means. And so I do think that supports still hold as long as our junk bonds ADL line keeps going up. All right. If our junk bonds ADL line keeps going up, then usually the supports hold. Now, having said that, where is support, right? Well, if we look at the S&P 500, I think it's a very, I think there's a very good chance that we could come back down to here around 3,900, 3,850 to 3,900 or so. All right. If we still do, I mean, that still would be on a daily basis, a higher high and a higher low. All right. I mean, if that's all it takes, actually, too, we can go all the way down to, 3,800 and maintain that higher high, higher low. So, I don't think it goes down below 3,900, especially this week because of options expiration. There's just so many in-the-money puts right now, and they're about to expire. And so I don't think if it happens this week that we'll go much lower than that 3,900 zone. But maybe perhaps afterwards, maybe that continues, and maybe this continues and gets down to 3,800. Still, the daily uptrend from middle of October would still be intact at that point. And again, I'm still waiting for that 41.25 zone. That 41.25 zone is where I'm just going to short using SPY puts, vertical spreads 3 to 6 months out. Or I might use QQQ if our growth to value chart still points downward, which it still is right now. It's still in a downtrend. So I might be using that too. I might be using QQQ as well. But we'll see, okay? We'll see when that time comes. When it gets to 41.25, we'll see where this ratio is. And again, if we don't see a clear direction or a clear trend in this, we can always just use SPY, right? Or if this is still pointed down, we'll use QQQ, okay? But anyway, so our liquidity data right now is showing that, junk bond data is stabilizing, and it's actually now liquidity is entering the market. And again, it doesn't necessarily mean the bear market is over. I still think that this is just a bear market rally, but this bear market rally could last a while, just like it did right here when it gave us a signal back in July. That one lasted for like 6 weeks. I think this one could last a few weeks to a couple of months as well, maybe into Q1 of 2023. Definitely a possibility. It's all within the spectrum of probable outcomes. And so, I'm just going to keep an open mind and just review the data and just literally we're going to go by what the data tells us. It's not really about the narrative. It's about what the data tells us. Our New York high-low line, it just got... our New York high-low line is still going up. It's above our first moving average, so that is stabling as well. Although it's not above all of its moving averages. When that happens, plus the junk bonds ADL makes a higher high, higher low, that's when we have the mother of all buy the dip signals. And I went over that more in detail yesterday as well. So again, check out yesterday's video if you want to see why we look at this. But it is improving, okay? We're seeing liquidity data is improving. All right. New York AD line, advanced decline of the New York Stock Exchange also going up still. It's still in an uptrend, a short-term uptrend at least. And also equal-weighted S&P 500 is still around its highs. It made a higher high, and it's still kind of around there above the above the 200 simple moving average, the 200-day simple moving average. So there is still breadth in the market. So as far as liquidity signal is concerned, it is stabilizing. If we look at also rates as well, I think the most important chart is the TNX. As long as this is coming down, we could see multiples expand, okay? And so if this keeps coming down, especially growth stocks, tech stocks are going to love this. If TNX keeps coming down, if it really starts breaking down, I think if it gets under 3.5, which is, in the next couple of weeks, this could get down to under 3.5. And that's the case. I think then our IVW IVE chart may switch and we might see an uptrend in this line if TNX drops below 3.5. We've been looking at other indicators for the 10-year Treasury. One of the things we've been looking at is the copper to gold ratio. The copper to gold ratio tends to, let me overlay both those charts together. All right. So if you actually if you take a look, it tracks it very well. Now, sometimes there are divergences. Whenever there is a divergence, it tends to be that the TNX will play catch up to the ratio. All right. And sometimes it could be like weeks. It could take weeks for that to happen. Sometimes it takes weeks for this to come around and come back down to the ratio. So, I do think that they will meet at some point, maybe somewhere in the middle. So I do think that the yields will drop, based on this ratio. It could drop and it could meet somewhere around in the middle, around, maybe around 3.5 or so. And again, we've been anticipating this. With this ratio, we've been anticipating this for a while, since July, August. So is this finally the time when this comes back down? It could be. Okay. And again, it tends to be this this way ever since around 2007, 2008 or so. Copper gold ratio has been a very good indicator of where the 10-year will go. 10-year yield will go, but of course sometimes it runs it by weeks or months. So as far as a day trading signal or a short-term swing signal, it's not the best, but it is something that we can use to anticipate down the road what could be happening in the bond market. All right. So that's what copper to gold is telling us. And again, if it's any indicator and if it's any indication of where TNX will go, if TNX drops and 10-year yield drops, I think growth stocks will do incredibly well. And again, that's the reason why I think that this could last a couple of weeks, maybe even a couple of months. You guys know what my thesis is on the January February CPI print. You know, we anticipated that at the end of the year we would be seeing a drop in the CPI number, which we were right from the last CPI report last week. You know, we were right about that. We were dead right, and I think in January, just based on the data, based on the commodity prices and the Fed funds probabilities, I do think that in January we see another surprise low print on that CPI, and that could really give like a sugar high to the QQQ, and that would probably be a good opportunity then to short the QQQ at that point. Let's get rid of this one. So, I mean, that's what I'm waiting on. And so at that point, maybe then QQQ or the NASDAQ maybe around 13,200, 13,300. You know, it could go up to there. And that would probably, that is where I start shorting some tech stocks. All right, that's where I would go and look at some inflated tech stocks with very low earnings and high multiples. And then I'd be setting up some put spreads on those. All right. But again, I think that's going to be more around January, right after that CPI print comes on in January, or February, January or February, somewhere around there. That's where the data is telling us that we might see even a lower CPI print. So I'm waiting on that too. And again, I think that zone is going to be around 13,200, 13,300 by that point. Okay. So around January, February. So around here zone right there. Okay, so that's where I'm really interested in shorting the QQQ. But as far as setting up some puts on the indices, I'm still initially going to be doing that at 41.25 on the S&P 500. Okay, that part still hasn't changed. Although I'm now changing my plan just a little bit, where if we get to 41.25 in SPX, I'm leaning now towards just you doing this on SPY. And then for QQQ, because here's the thing. The S&P 500 could come down, but the NASDAQ could still be going up. Okay, we could see a scenario like that. And if that's the case, I don't want to be holding QQQ puts if that's the case. So I may just, instead of getting too clever, I may just go with the index that I'm using the trigger. So the trigger for the 41.25 obviously is S&P 500. So I might just be using SPY for the puts when S&P 500 gets to 41.25. I think I'm going to save the QQQ puts for later on, maybe around January, February, when the NASDAQ gets to around 13,200, 13,300. So just making a slight change to that. My U.S. indices, the trigger at least, still hasn't changed, okay? So the bulk of the plan still hasn't changed, all right? So I just wanted to clarify that. So that's the S&P 500. That's our indicators. Bond market, TIP, TLT. We've been using this as a indicator. I'm gonna lay off on using this as an indicator for now, just because right here, all right, around a couple of weeks ago, we had a tranche of inflation-protected treasuries that got a huge bid because it was the last one that was going to be a 9% annualized yield. And so we saw a huge bid for that, and I think that distorted the TIP chart, and that's why it's distorting this TIP, TLT. Let's wait. Let's give it a few weeks. I think after the effects of that inflation-protected treasury auction, after the effects of that has worn off, I think TIP, TLT will give us clear signals again. But that inflation-protected treasury auction, I think, kind of distorted this chart. So I'm going to stop using this. And actually, for the last couple of weeks, I've been telling you guys that it's all about TNX. I still think it's all about TNX. Really, the TIP chart, though, is all distorted because of that previous auction. Once there's a few more auctions with lower yields, I think the TIP chart normalizes. Then TIP, TLT can be used again as an indicator. But for now, TNX. Where TNX goes, that's really where it's going to tell us which part of the market's going to have strength and where's the market going to go, at least in the short term. Okay, so TNX, that was the chart of the day, like from 2 weeks ago. It was literally the chart of the day for the last like 2 or 3 weeks, and it still is. Okay, it really is. It's all about the TNX right now. So for risk on, risk off, take a look at TNX. Also, the currency markets have been pretty accurate in risk on, risk off sentiment. The dollar is still coming down. I think the dollar is still what people are looking at. If the dollar keeps coming down, I think that's very supportive of this bear market rally. We could see the dollar pop up just a little bit, retest the breakdown, and then come back down again. And if that's the case, we might see a little bit of volatility in the markets. But unless this starts making new highs again, it's still in no man's land. Kind of, we're very close to a zone where I think it may pop up. We just missed it, just by not even by all that much. So maybe that's. Maybe it's just bouncing from there. I don't know. It could happen. But one good risk-on indicator, GBPUSD, the British pound. All right, the British pound, the euro, and the Japanese yen. Okay, the euro, the British pound, Japanese yen. Those are the three currencies you want to be looking at for risk-on, risk-off. There's just a lot of dollars that are in these foreign dollar accounts, and if they come out, they need a new home. Basically, it's going to be buying assets, and how we can tell if that money is coming out or not is by using these rates, these exchange rates. If we see that there's a lot of British pounds being bought, euros being bought, yen being bought, that just means a lot of these dollars are coming out into those markets. Although it does, with these wicks and everything, it does look like kind of it feels toppy. There's no I don't have any data on this, but it does feel as if this is going to top a little bit and then maybe come back down. And again, it might be a temporary pullback on the market when that happens. So just watch out for this. All right, Euro USD, same thing. Euro USD also has those tails, but it is advancing for today. And again, unless this breaks down and it breaks that higher high, higher low trend, I do see that this may, at least this is going to be tailwind for us as far as risk assets are concerned. Japanese yen, remember here when I said, I'm glad I missed out on the trade? Well, now in hindsight, I kind of wish I was in the trade. That's a huge move. This is like catching 500 points on the S&P 500 futures. That's a huge move. This is usually like what a currency will do in a year, and it just did it in a couple of days. So there's a lot of opportunities out there, if you know where to look. Too bad we didn't really enter here. Should have had more conviction. It is what it is, though. There's going to be more opportunities soon. All right. In the last couple of minutes here, I did want to go over some of our thesis. We started yesterday examining our investment thesis for the end of the year into next year. Just a recap of that: metals, especially uranium, precious metals, platinum, food commodities like chicken, alternative proteins. When I mean alternative proteins, I'm not talking about like those plant-based proteins. I'm talking about chicken and pork, because beef prices are going up. When in the United States, when we see beef prices going up, we start seeing demand for other protein sources. So that's part of our investment thesis, as well as oil tankers and energy. So today I wanted to go a little bit deeper into those theses. Today I'll cover FLNG. So they just had their earnings yesterday, and I said I'd go over their earnings transcript. So we are seeing FLNG coming down a little bit. Remember, it gapped down after earnings. Usually after a gap down after earnings, I like to do a 3-day rule. And especially with the momentum it has had, I wouldn't be surprised if there are some leveraged traders that are long on this. And so with a drop like that, it could cause a margin call situation, and usually it takes about 3 days for those margin calls to work its way through its system, just because brokers usually give people 3 days before they start force liquidating, and so that day comes on Thursday, and so if by Thursday, if it gets to around 30 or so, that may be a good zone to add long. They did talk about their dividend. It looks like their dividend, they're talking about a potential increase to their dividend, which is a good sign. They did talk about, the state of the LNG carrier market. One thing that I thought was very interesting from the call on FLNG was that if right now, based on what the management is saying, if you want to order an LNG carrier right now, you're not going to get one until 2027. Okay, so from now until 2027, there's a limited amount of ships that are out there. And that, and so even though the average, bulk and dry index, the average shipping rates may be coming down, the rates at which LNG carriers can charge may still go up. And so that they're hopeful that that's the case for their business. And I think that's the case too, especially if these, Russia sanctions continue. Definitely, some of these countries are going to have to find other sources for natural gas, and they may have to rely on different shipping routes that are being used right now. And so I think FLNG is very well positioned in that market to take advantage of that. One thing though, one warning is that they did enter into another agreement to supply shares in the market in the New York Stock Exchange. I think about $100 million or so that they're planning on raising through share offerings, which means they're going to dilute shareholders. Okay, so I think that's where a lot of this is coming from. I think that they announced that yesterday right after the earnings call. So I think that's where a lot of the fear is that they're going to be offering shares. So again, we're going to wait for a deeper pullback, and again around 30 or so, I think that would be a good zone. I have my alerts set for right above 30, and I just want to see what happens to price action. If I see that the FLNG is starting to reverse from hitting that 30 zone, I may start getting into some leaps on FLNG. Okay, leaps, and I'm looking at specifically I'm looking at the 793-day leap. By the time it gets to 30, hopefully this 22.5 strike or this 22.5 strike will be closer to 10. All right, that would be a great entry point. All right, and it allows me to also sell covered calls, poor man's covered calls as well too, and that's what I'm looking for. Hopefully we can get there. 22.5. This one, if I can get that at 10 or so, I would be happy. I'd start legging in there, okay? So, initial buy first, slowly, okay? There's no rush in this. I'm going to be building this position out slowly. There's 2 years on this trade, okay? So there's no need to be rushing in and shooting all of our bullets all at once, okay? So I'm going to be entering this and legging into this slowly, all right? Because you never know. It could undercut that 30. If it undercuts 30, I mean, even if it wants to maintain its upward trend on its weekly basis, I mean, this could go. This could go into the mid-20s and still maintain that upward trend. Okay, I don't think it's going to do that. I do think it's gonna. I think around 28 to 30 zone. That's where it will find some support, especially in this environment, and especially with the dividend going up like this. And them expecting to raise the dividend next year or the year after, I do think that this will have some legs. This will have some support right here. All right, I don't think this is over. There's other plays too. I mean, right this week, I think FRO will also report. So I want to see what happens on those other carriers as well. I want to see what their opinions are on the market. I think that will be very telling on what the container and cargo market will look like. So I'm going to be looking out for some of these other reports as well too. I think Sting also. Oh, they already reported. They did better than expected. This is also another good candidate. There was lots of dark pool and block purchases on this last week. If this one were to fall back, you know, if this stock were to fall back to around 38, 39 or so, this would be a great buy as well too. FRO also has a very good options market. 793, that's not so bad. If it goes to oh no, I'm sorry, I'm looking at the wrong thing right now. I was like, why is it so different? So yeah, STNG, you know, if that goes to, let's say 39 or so, that means what? If I want 3 to 1, I still want to get in at 13. For that one, just because of the IV, I may want to go into the 429, the 429 expiration. That would be January 2024. That would be like an at the money call a year out. We'll see. Okay, we'll see. And again, my main buy, the main one that I'm looking at is FLNG, and I'm waiting for that 3-day rule. So hopefully tomorrow it's getting closer to 30, and again, if that's the case, I'm going to be entering that trade right here. And just from the earnings, again, one of the things you got to look out for is that they are raising cash through share offerings, or they're diluting the shares. So so again, that's why I want to be getting into deep in the money calls so that I can be selling covered calls on this, because inevitably, if they need to raise cash, they're probably going to be selling shares, especially since their share prices have gone up so much. So every once in a while, as this goes up, they're probably going to be offering more and more shares, and if that's the case, we're going to see some dips along the way, and I want to be harvesting some of that premium as that happens. So again, this is what I'm looking at, and I'm going to start lugging in once it gets to around 30 or so. All right. So that is a deeper dive. And again, if I see anything tomorrow, I think tomorrow some of the oil tankers, I think they report. So if I see anything, I'll let you guys know tomorrow. UUUU, also, I said I'd go deeper into our nuclear thesis. There seems to be a lot of interest in the nuclear thesis. Yesterday, I got a couple of DMs asking me to really dive a little bit deeper into UUUU. So yeah, UUU is one of the plays that I came up with. I like UUUU just because they have no debt. Okay, they paid off all their debts recently. They are restarting their mines. They do have more longer-term contracts. They started getting into some of those contracts beginning of this year, and they're expected to, get some more of these contracts as time progresses. They are expecting more of these contracts to finalize sometime in the beginning of 2023, and I think it sets them up for some growth in the years ahead. Not only are they in uranium, but they're also in radioactive isotopes for medical equipment, as well as rare earth minerals like vanadium that are used in metal alloy making, as well as electric vehicle batteries. So they're in those rare earths as well too. It's not just a pure uranium play, although UUUU does track the uranium stocks pretty well, although in the last couple of weeks it has diverged a little bit. UUUU has shown relative strength against uranium plays. I promised you guys that I'd be sharing with you some other names. I also like DNN, which is Denison Mines. I like this stock too. This is a little bit more speculative. It is a smaller uranium play. It is a Canadian company. They do have mines though here in the United States. This is a more pure play uranium stock, although I think this is going to be it's a speculative play, but I think this will do very well too. If uranium prices really do well, and there's a great interest in uranium, and again, guys, from the thesis, I think uranium, we're going to see a nuclear renaissance. The reason why is because fossil fuels are just getting more and more expensive. And with natural gas, with a lot of people, or with a lot of European countries relying on Russian natural gas, it makes sense for them to now try and get away from that and rely on themselves. And right now, you know, a lot of these European countries have some type of nuclear capability. In the past 10 years, it's been very unpopular with some of these accidents, like in Japan, you know, Fukushima and all of that. A lot of countries have gone away from nuclear, but now with all these Russia sanctions and with some of these countries getting belligerent, you know, now the story on nuclear is changing. You know, Germany wanted to close down all its nuclear power program. A couple of months ago, they came out saying that 2 of their nuclear power plants they were going to keep open just in case. So we're already seeing governments starting to get really friendly towards this. South Korea did a 180-degree policy change. You know, they were trying to phase out nuclear, and now they're getting back into it. France has been expanding their nuclear capacity. Japan also is doing a 180-degree policy shift. They were also trying to phase it out after Fukushima. Now, you know, they're exploring ways to diversify their energy infrastructure, and nuclear is part of that. So again, I think nuclear is going to be more and more of a alternative, and governments are going to have to start getting friendly toward this. And the United States has already done that. The U.S. has already signaled that they are accumulating uranium inventory. And so UUUU is also one of the candidates for the Department of Energy uranium purchase. They expect an announcement from the DOE sometime later this month or next month. And that's another reason why I think UUUU is going to be a great play. But DNN, also a good play as well, too. It's a smaller company. This is way more speculative. I mean, uranium itself is a pretty speculative market. But out of that, I would say the smaller uranium miners are even more speculative. So DNN is one of those. I do think there's a lot of upside, though. If my thesis is correct, okay, I think DNN will shoot up, and we'll probably see huge returns coming from DNN if that's the case. I mean, DNN could go up to like $8, $9, $10 a share just from increases in the uranium price and increases in orders, especially from utility companies. So if that's the case, I mean, this could go up again, $8, $9, $10. You know, back in the last uranium boom, it went all the way up to like $15. So it's not that out of the question for this to happen. Again, we'll see. But this is another speculative name. DNN does have an options market as well. So if you guys are, I guess, really feeling risk on, you could be buying this. I don't think that's a good idea, to be honest. I mean, if you want to lotto into something like this, I mean, I guess you could. And I guess it's relatively cheap. But I mean, when the share price is less than $2, I mean, why even bother with this? I'd just be buying shares. All right. I mean, if this thing goes to $8, $9, that's still a good rate of return. There's no need to be greedy and buy these highly inflated leaps on a low dollar stock like this. I think for DNN, I think it's all about shares. And plus, you know, as it churns or you know, if it takes a while for this to go up, hey, you can always sell covered calls too, right? All right. So this is I told you guys I'd be sharing some names. So again, DNN, that's also on my radar. You know, when I see that everything is changing, when I see the earnings coming out, you know, when CCJ says that, oh, they got more contracts than they know what to do with, that's when we start going long on DNN. That, to me, is the trigger to get long on something like DNN, okay? I already have uranium exposure. Again, my biggest my biggest position in my speculative account is UUUU right now, okay? So tomorrow I'll go more in depth on precious metals, platinum, and our food thesis as well too. I've got there's not a lot of food stocks out there that I can share with you guys, but I will share some more precious metal plays. Maybe and I think actually too, I might even cover deep sea oil drilling as well too. There's a couple of names that I'm looking at, and if oil maintains this price above 85 for an extended period of time, deep sea drilling becomes more and more attractive. Okay. And we saw this in the last oil boom too. After about 6 months to a year of prices being elevated back in 2013, 2014, we saw a lot of deep sea drillers benefiting from that. And I've got a couple of names that I want to share with you guys tomorrow, and I'll share my thesis with you guys on that as well too. Okay. Anything else you guys want to look at for today? Going once, going twice. Oh, right. In that case, today we will end our episode of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord. Be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on tomorrow, 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern Time. Hope to see you guys then. Have a great day. Trade safe, guys.